This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings and welcome to Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by our macro advisor, Edge manager, Craig Shapiro. So this is Fed Day, of course, and we try to unpack all that just transpired both in the Fed decision, Powell's Q&A, and then, of course, the market reaction across all assets. But what the hell just happened? Dollar dumped and equities correspondingly dumped. But precious metals are definitely hot fire flames. And I'm kind of curious your take on his review of inflation expectations staying sticky, GDP growth, rates moving higher, and yet they still have 3 programmed cuts for 2024. Craig, dissect this, please.
Yeah, there was a lot. There was a lot in here. There was a lot today. I think there was a pretty big divergence between what I thought I saw in the dot plot than what Powell was speaking about on the call. On the press conference. So let's unpack this a little bit. I mean, basically what we have is a situation where there was an expectation for the 2024 dot to move from 3 cuts to 2 cuts. And so what wound up happening was that the median dot stayed at 3 cuts for 2024. However, the mean dot for 2024, the average, actually moved up. So meaning there's less cuts. And that is done by the fact that there were 5 cuts. In the prior dot plot, there were 5 folks who are at 4 cuts for this year and 1 person who was at 6. The person who was at 6 is now at 4, and all 5 of those people who are at 4 are now at 3. And so what we have is we have 10 members who are looking for 3 or 4 cuts this year and 9 members who are looking for 2 or less. So it really wasn't it wasn't dovish at all. Really, the mean of all of that is less cuts for 2024. The Fed also took up their expectation for PCE in 2024 from 2.4 to 2.6%. So in addition to that, the 2025 dots were revised higher. So a rate cut was removed. The 2026 dot was revised higher, another rate cut removed, and the neutral rate went up from 2.5 to 2.6%. So really across the board, in my view, my initial view was that this was actually a fairly hawkish collection of data points that came out. And it wouldn't have been a lot if instead of it being 10-9 in favor of 3 versus 2, it was 10-9 in favor of 2 versus 3. I think the market would have been a lot different, but it is what it is. It was the reaction function that we had on a Fed day where vol is very elevated into the event. And so once the event is over, the intraday vol selling came with reckless abandon. So then we
did have a lot of puts as hedges for
sure. So for sure. So that's all part of why the equity market rallied as much as it did. I think it probably was going to do that no matter really what was said in light of the vol being elevated into it and all the zero day to expiry monetization that had to take place. So then we get to the press conference where, look, I mean, I was looking for Powell to, and I've been talking about this, come out and acknowledge that the easing of financial conditions that we've seen over the course of the last 4 to 5 months is actually a self-defeating issue, and that makes it more difficult for the Fed to achieve its objective. And what he said was it's no issue, and that they're not concerned. He is not concerned about the loosening of financial conditions. He still believes that financial conditions are restricting growth. And look, if that's the view of the Fed, again, I've said this and others have said this, but we need to trade the Fed that we have, not the Fed that we want. And so even though it's clear, I think to myself and to other economists that the loosening of financial conditions is aiding growth and aiding inflation. The Fed doesn't see it that way. And even though the dot plot suggested a more hawkish construct, the loosening of financial conditions, I think overwhelmed that. And so I think what we saw as Powell was speaking was an acknowledgement that the Fed is going to be, it seems like, more comfortable with inflation not getting back down to 2%. As the market rallies and as inflation expectations move higher. And so I think that is ultimately going to be a mistake, but that's really a topic for another day. And so right now we have, not surprisingly, Bitcoin ripped and it will continue to rip, and gold ripped and will continue to rip. And I think oil will be next and that will continue to rip. And so my bias going into today was to be long those inflation assets, lean calls on those inflation assets, Bitcoin, gold, and oil. Be short bonds, which I think frankly played out okay. I mean, TLT ended the day down on the day and lower than where it was at 2 o'clock. So the long end sold off. That made sense. And I'm short small caps because I think that they will suffer in a higher interest rate, higher inflationary world, and clearly that wasn't the reaction that we got, so far. But we'll ultimately see what happens. So that's the summary as I see it.
How about this chart that you put up?
I just posted this chart. It's something that I saw. The guys from ICAP had published this. It's not an indicator that I had been familiar with, so I went in and took a look at it. And basically, what this shows is how each Fed member views the balance of risks in GDP, employment, PCE, and inflation. And as the numbers go closer to 1, that means that they assume the balance of risks to be upside risk. And as we go down towards -1, and that would be, that they assume it's negative risk. So if you look, each of these indicators, and they update this quarterly in the dot plot, each of these indicators moved up in this, in this dot plot. And so I have unemployment inverted there. So that's basically more confidence that employment is going to be good, so more confidence that unemployment will be lower. So across the board, there is upside momentum in the risk trajectory as the Fed sees it in inflation, in GDP, and in employment, which is why I believe the mean rate moved higher, which is why the neutral rate moved higher. And yet the stock market had a very different reaction to that data or that conclusion. And so I think the stock market reacted to the press conference being more dovish, and the likelihood that the Fed is still going to be on a path to cutting rates this year, probably in June. But as we've talked about, the more the Fed thinks that they could cut rates this year, the more that inflation expectations will move higher. And actual inflation, I believe, will continue to move higher, and it will make it more difficult. But we're not gonna know that until we get closer. And so I think that's kind of where things settled at 4:11 today in the afternoon. And I know that vol was very bid into one day vol was up to nearly 20 into this, and so we need you need to destroy that after 2:30. And so we see this time and time again into these events. Whether it's CPI or PCE or payrolls or Fed meetings, that the vol and all the hedging gets done on zero data expiry. Vol gets incredibly elevated for the event, and then as the event comes and goes, no matter what, we get vol. And so
also move. Take a look at that if you would on your and then.
Yeah, look, the bond volatility has been continues to come down. Right.
Yes.
And it's been at move. You mean the move index, right? Yeah. So bond volatility has continued to fall, and I need to see today's. I don't know if it is how bond volatility. I'm not sure that bond volatility came down today. I mean, we'll see. But my view has been that the Fed needs to introduce rates volatility in order to tighten financial conditions and to discourage animal spirits, and which will lower inflation expectations and lower overall inflation. I thought the dot plot was a move in that direction. Powell's press conference was not. So we have to deal with that reality. I mean, we'll see. I mean, right? Like I think I've been writing a lot, the last week or so just about the Fed and how I see it. And I think you still have a situation where there's several members who are voting members who are not going to be in favor of a cut. And as they speak in the coming days and weeks, we'll get a sense of, whether or not they are going to support that. And I don't think that Powell is desirous of engaging in a rate cutting cycle with dissenting votes. So if inflation data continues to come in hotter than expected, we're gonna keep playing this game. We'll keep playing this dance, and we'll keep pushing the rate cuts out. But for now, this reaction. I was a bit surprised. I wanted to short stocks, at 225,
We'll get there.
ahead of the presser, and I didn't anticipate that kind of presser.
Well, let's talk a little bit about QT, and then I want to go into the dollar yen announcement exactly at the same time, which caused a sharp reversal and helped kind of keep yields, tapped down and bonds from crashing as the dollar continued to fall. But first, what's the Powell temperature on QT?
So I think there was probably a minor dovish surprise in that he said that the decision on tapering QT would be happening fairly soon. And when the Fed says fairly soon, that typically means the next meeting. So we should probably look forward to an announcement from the Fed at the next meeting that talks about lowering QT runoff. Probably as soon as maybe announce it at the May meeting, starts in June. But what he did say was that this does not change the ultimate destination of where the Fed expects its balance sheet to go. And in fact, he actually suggested that a slower pace of QT over time would help prevent the types of repo market blowups and bank blowups that we've seen in the past. And so it's possible that the actual level of ample reserves may be lower than what the Fed had originally thought. So I think we are going to, so it was dovish in that it's going to start maybe a little bit sooner, because it's probably going to start in June. But I don't ultimately think it's, a too dovish a decision if they're going to continue QT for a longer period of time. The other thing that he said was that these other issues, which Waller discussed about possibly selling mortgage-backed securities or a reverse twist or, some other thing on the composition of the balance sheet, those are not going to be imminent decisions. So it seems like that's more of a discussion for later this year. And so I've been talking about and potentially looking for, and I think the Fed should be more aggressive and more active in its balance sheet composition decisions, but they're not there yet. So that seems like that decision is more, if it comes at all this year, it would be later this year.
All right. Let's just share this real quick. So I show the dollar yen. We had a little sharp reversal intraday with an announcement that they could hike rates again in July. Trying to find the exact chart, but you get the feeling that 152 area is still a really strong level of intervention. And your thoughts on Bank of Japan? Yeah, here it is.
Yeah, I mean, it's hard to say, right? I mean, this data, this came out right. It kind of came out right at the time that Powell was going to start speaking,
Exactly.
it was why Powell was speaking. And so, look, I mean, my view on the BOJ is that ultimately Bank of Japan owns, a significant amount of the Japanese government debt, and really is not in a position to have an aggressive rate hiking cycle begin under their watch. And so, I think it's really just a question of they are going to allow the yen to weaken. They want it to weaken at a gradual pace. And if it starts to seem like it's weakening at an accelerated pace, you get these tape bombs like, they're going to raise rates, or the MOF's going to intervene, or what have you. But ultimately, I think Japan is not going to go rapidly on a rate hiking cycle. I think there had been some expectation into this BOJ meeting about them being more hawkish and ending, bond purchases or what have you. They're just, they're going to be accommodated for a long period of time. They're going to be slow at raising rates. They're going to let the yen do the work. And I think the dollar yen continues to move higher. from here. And, I don't, we'll see about this announcement that comes at 2:52 on the same day that the Fed is meeting. I don't know. And July is, they just raised. So I don't, if they raised 10 basis points in March and then they raise another 10 basis points in July, I mean, who cares, right? It's not, it's not really such a big deal. Yen carry trades are still very attractive. There's not much in the way of risk to that blowing up. So
there
I think
is over time, depending on the rate of change. Right now, it's
yeah. Look, and if they're going to do
very
10
minimal.
basis point moves every 3 to 4 to 6 months, then I don't think that we're in any jeopardy of having that unwind. I think more likely what's going to happen is the yen is going to be the outlet. Will continue to weaken, particularly if the world sees, accelerating inflation, right? If oil goes up and China is stimulating and all commodities are going up and Japan needs to buy commodities with a weaker yen, that's inflationary. So I think the yen winds up being the outlet.
So that's just a great chart that I happened to grab this morning on the yen carry trade, 4 trillion worth. So it's typically something that would take time to unwind, but slowly then maybe quickly, but we need more of a macro mover. All right, so you've kind of gone over some of the recap of this complex little rate cutting schedule that they have. 75 basis points this year, 75 basis points next year. Of course, they can change. And the growth, the GDP that they see increasing was actually quite a big.
Yeah, I mean, they made something mark to market. Wall Street had been at, kind of took numbers up to 2.1%, and the Fed was, I think, was 1.5. They went to 2.1, right? So they revised. It's a conflicting message, right? They revised higher their GDP estimate. They revised higher their core PCE estimate. They, and they took the mean dot higher, but the median dot stayed at 3. Even though, more members now assume less than 3 cuts than we did last SEP. So, I think Powell, if he wanted to, he could have leaned into that more, right? He could have, when he was asked about why are we still doing 3 cuts, he could have said, well, as you can see, 9 people still say, 2 or less, right? He could have leaned in if he wanted to. And he chose not to. He chose to, which suggests probably that he's at 3 cuts and that he wants to start a cutting cycle probably in June, and maybe go June, September, December, and that's what he wants. So it's that's I think that's where we are. And if the data comes in better than expected between now and then, he may still go. And if it comes in worse than expected, he's definitely going to go, right? And so it was a bit of an asymmetric outlook from him today. So I think he was speaking more. It seemed to me like he was speaking more for himself and his views today than he was for the entirety of the committee. Because the dot plot did not show the degree of dovishness that I think he showed.
This is just kind of a recap. Fed raises long-term interest rate projection to 2.6 from 2.5 and expects rates above 3% through 2026. So just also in keeping with that sticky inflation and GDP growth and rate growth and employment will just stay nice and calm. So it is a Goldilocks scenario.
I mean, look at what they've done here, right? Even just if you look at if you just assume the year-end Fed funds rate, less PCE, less core PCE, that gets you some sort of estimate for real rates, right? So right now we're at 4.6 versus 2.6, so 200 basis points of real rates, right? That's down from December, which was 4.6 on 2.4, which is 220 basis points of real rates, which is actually down from September, which was 5.1 on 2.6. So that was 250 basis points of real rate. So the Fed has gone from 250 basis points real rate in 2024 to 200. Inflation has now reaccelerated and moved higher. So why are they moving in the direction of real rates being lower? I really have no idea. And so I don't want to be conspiratorial, but I mean, look, if you wanted to be, and you wanted to say, why is the Fed doing this? You could argue that maybe the Fed is looking at the U.S. government debt situation and saying we'd like to help the government out, but that hasn't been something that they've talked about. But clearly, if they lower rates, it does help the U.S. government interest expense. But and in a position of fiscal dominance, that would make sense. The Fed hasn't discussed that, but
no.
When we move in that direction, it's hard to completely discount that as a possibility. But look, I think this. again, I think we are, the Fed is buying into this productivity-driven economy story, it seems, right? That we could continue to get robust economic growth and a strongish labor market without wage acceleration, and inflation can come back to 2%, right? They are patting themselves in the back on the achievement of a soft landing and the immaculate disinflation. And what they are saying is that even though the data to start the year has come in hotter than expected, it will go back to the trend that they assumed it would be on. And we will see, right? I mean, that is literally, we will get to see that story play out over the course of the next couple of months, whether or not they're going to be right or not. I think there are many Fed members who don't believe that to be true, right? Because they are the ones who are saying 2 cuts or less. But we have to now wait and see how the data, comes in, because this, because Powell doesn't think that a significant loosening of financial conditions, really will lead to a further reacceleration of inflation. And I think that is where, the rubber meets the road. Rubber hits the road, whatever the phrase is.
All right, so let's talk a little bit about the market reaction. And this was the dollar dump. I've got a 2-hour intraday. So just to kind of clarify here, we're not looking at weeklies or even daily timeframes, just to kind of show the extent of the move. So dollar dump that was very, very solid, and gold obviously ramped strong with equities, but this actually took off first. So it was very apparent that dollar was weakening and gold was getting above a key level. And then Powell really kind of ignited the animal spirits, and SPX and NASDAQ took off higher. Even before that, small caps did. So they already kind of smelled that yields were going to stay flattish to lower, or, in the house, let's put it right over here, because they were actually very strong before the rest of the market. Oil just kind of sat there. So I'm looking at this timing of the dollar yen, right? That announcement that they could hike in July, exactly then as yields were about ready to push up to this 4.36 area, which is kind of a danger area. If we get above, in my technical analysis world, that means bonds are going to be under more distribution. So we didn't get that. We absolutely didn't get that exactly on that timing of that announcement, because I happened to be running that live trading room from 2 to 3 this afternoon. So I was looking at all of this at the exact same time. Headlines, dollar yen, and this 6-panel display. So that happened to kind of suppress the 10-year from getting too out of hand.
Yeah, I don't know why that would be.
That dollar dump. Let's talk a little bit about the strength of that, if you would, please.
Yeah. Look, I mean, I think I'm surprised by it, frankly. So I do think that, this, I think this reaction in the dollar, is the market saying that the Fed is going to be comfortable with an inflation environment that does not return to 2%. And so if we have an environment where the Fed is going to be, they basically are in no situation are they going to be raising rates, which is kind of what, they've said. And they're more likely to be cutting rates, even though inflation's reaccelerating. This is a dollar weak story, good for nominal growth. And it's a dollar devaluing against gold and against Bitcoin and against real assets. And I think that's how the market traded it. And then to your point, I think that there was probably some, follow on from this BOJ situation. But if the Bank of Japan is going to raise rates further, then you would expect, U.S. Treasury yields to sell off, or yields to go higher. So I don't know why that the bond market would rally on that. But look, bonds are kind of at close to the lows of the day here. So I think
they were totally flat. Exactly.
Yeah. So I don't look. I think to me the reactions across markets made a lot of sense. And I think we were, look, my bias was that things were going to come in hawkish, and so, but my fear was that Powell was going to speak dovish and kind of not acknowledge this loosening of financial condition situation. So the positioning was into it, kind of long these gold, Bitcoin, oil calls, and short bonds and short stocks. And I think that positioning, played out okay. Gold up, Bitcoin up. Oil was kind of crappy to start the day, so that and rallied a little bit. And stocks, bonds closed weaker. Stocks, reacted like Bitcoin and gold did, right? As inflation assets. So, from here, I think we'll see. I'll probably just keep these biases on. But,
I have a little bit different
CTA,
composition.
CTAs are long. Vol control funds are long. This
Very.
parity is long. The
Yep.
buyback window is closing.
Mhm.
Pensions are rebalanced for sale into quarter end. So, we need a lot of work here for the market to keep going. And clearly vol selling helped, right? Today there's a significant amount of vol selling, and we'll probably continue to get that through tomorrow and into Friday. But I don't know if I see equities running away, but I can understand why folks are going to continue to try to buy Nvidia and grow stuff. There's no sign yet that the Fed is going to be kind of interjecting to financial conditions continuing to loosen and risk assets, moving materially higher.
Okay. Mine was a little bit different. I really expect intervention at that 152 area. So tapping it back down with the dollar yen is just the playbook. They've done it before. They'll come up with any excuse. So in short, it's very hard for me to see yields, at least it has been, getting above that kind of 4.37 area. So expecting weakness in yields, and I'm very bearish dollar. So big picture, very bearish since November. US dollar has likely peaked. I'm still, big on that theme. So being short dollar is very bullish precious metals, period, but not necessarily just through FOMC. We usually get a solid bounce in gold, silver, and miners on FOMC always. Like it's just a thing. But big picture, I'm definitely bearish dollar. But today's dump in the dollar was much stronger than I expected. That was my only point. So yields did what I expected, not getting above 4.37. Dollar fell back, but stronger than I expected.
Yeah.
Gold, silver, and miners did their thing. Agricultural, or I should say, food related commodities are doing their thing. Now industrial commodities are starting to do their thing. Bonds just are weak, basically, in a nutshell. So this is what I was talking about from November and then January. And again, we still have a very bullish backdrop for equities. I still, see the potential of this kind of crash up boom type of framework for equities all the way up into that kind of 53.20, right? That was a price target from January if we really get going. But when gold started spiking on March 1st, I said, no, now we're going to calm down, because this is really a tell, for me anyway, that NASDAQ is getting a little bit too hot too soon. So the fact that we went sideways for the past few weeks made sense to me. Now the dollar dumps on FOMC strongly. Gold and silver, I get why they went higher. Totally. Equities, I understand. Obviously, it's a lovely tailwind for equities. But now I'm bearish. Now I actually think that this equities bounce or spike higher above 5,200. Originally, I thought it was going to go very strongly into 53.20, but now I actually think we're going to get tapped down into the end of the month. So this is very new for me, just because the dollar was so bearish in its reaction today. So I just want to hear kind of macro thinking about why it would not support an equity rally, because that's kind of what I'm looking for.
Look, I mean, Fed days are, exacerbated moves. I don't think that we're going to be in a situation where stocks fall if the dollar is weak. So if your thesis is that you think stocks fall because the dollar is going to keep weakening from here.
No. My thesis, absolutely. A weak dollar is very, very bullish for stocks.
Yeah.
No. Today was just a much stronger dump in the dollar than I expected. That's all.
No. Look, look. The dollar's been around. I'm looking at just the DXY has gone from 102 and change to above 104 in 2 weeks, right? So we've had but look, I think if the data in the U.S. continues to be fine and inflation is running, I don't see a material kind of sell-off in the dollar versus the euro, yen, or versus, or see that being a sustainable thing. As far as equities topping, look, I think what we needed to see is we need to see yields move higher. We need to see rate volatility increase, and we need to see the potential for the Fed to that the next move from the Fed could be a hike, not necessarily a cut. And so, look, I thought the dot plot was a move in that direction. Powell's press conference was not, in my view. So there's a disconnect there, and I need to try to, understand it a little bit more. But if we are in a situation, if we are in a situation where rates volatility actually starts to move higher, because people are thinking, man, And the other thing too is, and yeah, the move index got destroyed today.
Yes, that was baseline bet. Head and shoulders, it's coming down.
Yeah, so it made a significant new low, down 92.72. So a big drop in bond volatility. But look, what I had been saying is that a too dovish Fed was gonna be self-defeating because inflation assets were gonna rip on them, and I think we're in that zone right now. And how far does it go? I don't really know. If you go back to 2000, right, we went into the end of March, and then that was the top. If we could keep going, but I think between Bitcoin, gold, and oil and Nvidia, right, if we keep going, someone at the Fed is going to wake up like, shit, we have a problem.
So I see it differently. I see precious metal. I see food prices, I see precious metals, I see industrial commodities, but the fact that we're chasing speculative assets like Bitcoin and Nvidia isn't what it tells me that inflation is entrenched and reaccelerating.
No, I think oil is going to move up. I think all these things they're all going to move.
But oil's not allowed to go up, right? We have this very strong,
gasoline prices are moving higher.
They are, but I'm talking about big picture, right? It's an election year. Biden's got his policies.
The SPR is drained, and the SPR is going to be added to. The government has nothing here to do for oil, I don't think. I mean, I think oil is going higher.
Well, it's at 83. Above that, I'm bullish as well, but I think it does have the intervention collar that Bob talks about a lot. Marty wants to know, will they continue to support liquidity via repo market or Treasury general account?
I mean, we got from Yellen, an update at the last QRA, which was at the end of January, that the TGA was going to stay flat at $750 billion for the second quarter. And it's not, I don't really think there's any reason for us to believe that the TGA is going to go down. It would certainly be viewed as a highly political decision that Yellen could make later this year, spend money into the economy, without issuing more duration and more issuance in the third quarter, and she would get called out for it. But I mean, it's possible. But there is a minimum level of cash that the Treasury is supposed to keep, and 700 to 750 is basically that level. So I don't really think that that's a card that is going to be played by Yellen. If it was Trump and Mnuchin, yeah, maybe, but even he didn't do it. So I don't know that that's something that that Yellen's going to do. As far as the RRP is concerned, if you recall, we've talked about this, but in the second quarter, because of tax receipts that come in, we're actually going to have negative bills issuance in the second quarter. So the RRP is not likely to get drained really any further. I think we've already put a low in for the RRP. We're already up 80 billion this week. It's going to keep going higher into the end of the quarter. And I think we're probably going to be in the 450 to $550 billion range throughout the entirety of the second quarter, because we're looking at negative 200 billion of bills issuance in the second quarter. So there's less bills around to be bought, so more money can stay in the RRP. So that's not incremental liquidity that's going to come in. So I don't see that as an additional liquidity, tell coming. I think this idea that the Fed could be doing some tapering, maybe starting in June on the margin, is some liquidity, but really it's, we're talking about going from 60 billion to 50 billion. I mean, so it's not really, it won't really be a lot.
What about the T-bill auction that you mentioned this morning was poor anyway? Yeah. Had to dealers had to step up. And what would change this for actual buyers?
Look, I think it's bizarre that there's been lack of demand for T-bills. And we've had, I've pointed out countless auctions over the course of the last 3 weeks, which have come in worse than expected, where primary dealers have had to take on a significant amount. And
like half.
And you could say maybe this is because this was a Fed, the Fed meeting was this week and people were uncertain about the dot plot, and so they didn't want to tie up cash into these bills. Maybe some of these money market funds are trying to lower their duration, so it's not clear why, but yeah, I think it is a bit of a concern. Now, that being said, the duration auctions this week were good and last week were good. There's a lot of duration supply next week, 2s, 5s, and 7s, so we'll see what the demand trends are there. But we know that there's 500 billion of duration supply every quarter from now until forever. It's a lot, and it's not easy to front run that. So I think that's the dynamic of yields staying higher for longer. There's, because of the pressures on the supply side for U.S. Treasuries. The foreign demand is slowing for a variety of different reasons. And if oil prices move higher, you're going to have a situation where, Europe and Japan and China have to, sell treasuries to buy oil. So that's going to put some pressure higher for yields. So yeah, look, I think if my base case again is that yields are going to continue to grind higher, inflation is going to be sticky and continue to move higher, and the Fed, by not dealing with it, is creating a larger problem. And at some point, they're going to realize that they've created this problem, a larger problem, and they're going to be like, oh shit. And so, maybe it's at the May meeting, maybe it's the June meeting. I don't know, but there could be a point in time where they realize that they actually can't cut rates this year because inflation, because the March data comes in instead of 0.3% core PCE, it comes in at 0.5. And then now we're talking about, holy crap, 6-month annualized core PCE is now, back above 3% and moving higher again. And then the Fed would be really, really screwed. So they don't know that yet, but I think that's where we're going.
All right. So when do you think this timing of higher yields is really going to kick in? You had mentioned money market funds are kind of sitting on the sidelines because they have 1 year, not the 3-month or shorter duration 6-month, and they don't really have a play until November, December timeframe.
Yeah, look at the 10-year, right? I mean, 10 years at 4.27. It's kind of moved nicely. Kind of started the year at well below 4. We've moved 50 basis points to start the year. And I think we're gonna break out of this range and move higher and go towards 4.5% over the course of the next 1 to 2 months on back of this data coming in better than expected, the likelihood that oil moves higher, inflation moving higher, and all this bond supply. So today we kind of had an interesting day. We almost broke out, kind of came back, whatever. But I think you're going to see yields continue to move higher here. I like being short in the back, and I think what the market is may start to price back in is a bear steepener, right? I mean, it's this idea that the Fed is comfortable with higher inflation, which is why you want to sell the back, and they're not going to cut in the front. I'm sorry, they're not going to raise in the front to address it. So front end yields don't really move higher, but back end yields move higher. That's your steepener. I think that's how so I like that over the course of the next 1 to 2 months here is a higher yield scenario.
All right. So is this the one you're talking about here, just as an example? So this is the 10-year, 2-year on a weekly and on a daily. Are you talking about this in particular? Are you talking about
that we could find. Yeah. I mean, look, I think we've been talking about this 2-10 yield curve for a while, for months. What could take it back to that lower dotted line,
that gap fill,
or what would make it move higher? And really, it was about, is the Fed going to address, really when you kind of think about it, is the Fed going to address the loosening in financial condition? And if they were, we would go back down to the dotted line, which is a flattener, which is higher rates in the front to snuff out inflation and growth. And we had been trending there up until a few days ago.
Today. No, today.
Yeah. Oh, that okay. Right. Well, yeah, until today. And so if the Fed would have done what I thought it was going to do, and what the dot plot kind of suggested, but Powell did not, then I think we would have had this bear flattener. Now, I think he kind of blessed for now the steepener again, and I think now it's more likely that we're going to see this move back to that that solid red line than on the right side at least. Maybe not to zero, but a move higher in that which is a steep.
Yeah. All right. I wanted the visual to go with it.
Yeah.
All right. So we have a few questions. Let me just hit Thomas. Assuming Fed sticks to current overall plan of slowly easing and explains away any further bump. He used that word bump a lot for inflation because they don't really have a lot of faith in January, apparently. And explains away any further bump in April or May, then cuts in June. At what oil price, copper, etc., would long-term unanchoring cause short-term CPI, PCE above to change? I'm just going to kind of summarize that. It's a little longer, but
yeah. Look, I mean, I think
when is a bump is clearly not just a bump, but it's a road, highway.
Yeah. Here, I'll show you. Can I share my screen?
Yeah, go ahead. You've got total power.
Share screen. I know it's always a little bit difficult to see here, but this is retail gasoline in the U.S. seasonally. So the light blue line is where we are now in 2024, and the green line is where we were last year. So we are now higher year over year in gasoline prices for the first time, since, at least, call it the end of last year. Right. So we're now in a position where headline inflation prints can start to reaccelerate. I mean, the change in gasoline drives some very high number on the correlation of the change in headline CPI. So as gasoline prices move higher year on year, the trend in headline inflation will move higher. So it's probably not going to see that in the March data, right? But if this, if the trajectory of this continues to kind of move higher here, and we know seasonally gasoline demand and gasoline prices run through Memorial Day, and can run, if things are tight, can run through July 4th. So at least through Memorial Day, is the seasonal strength in gasoline demand. So yeah, it may not show up in the March data for April, but it will show up in the April data that comes in May. So maybe at the May meeting, as the Fed is looking for, through the April data, actually they won't have the April data. So at the May meeting, but they will, they'll be able to kind of tell if gasoline prices are moving higher here. We know the Cleveland Fed nowcast kind of predicts that. I would expect the April data for headline to show reacceleration. And then you're in a position where core inflation, sticky, reaccelerating, and headline inflation, sticky, reaccelerating. Again, I think it's very difficult for the Fed to talk about and actually engage in a rate cut when headline inflation is moving higher again. But we'll see. But yeah, to answer that question, I think that shows up more in the April data, that we don't get until May, excuse me.
Did you see I tagged you where Powell gave away the core PCE estimate for February? He said, quote, "We have it well below 30 basis points on core PCE data due on March 29th.
Yeah, it was a strange, and look, everybody has the same model. The street looks at the Fed doesn't have the data yet, any different than the street has the data. We're able to forecast core PCE by looking at the CPI and the PPI. The street is looking for around 0.3% core. So I imagine that's kind of where the Fed is. So maybe they come in a little bit below that. But yeah, he was, look, I mean, Powell was victory lapping in his in his prepared comments and in his outlook today. He really felt confident that the Fed had achieved what it said it was going to achieve. And that seems to be his view. It's not clear to me that clearly that's not the unanimous view of everyone at the Fed, because there's 9 dots that are 2 cuts or less. But, he seemed pretty confident, and we'll see. I'm surprised in his level of confidence in light of what we're seeing in this reacceleration of commodity data and of, just broad inflation data. I mean, this is kind of 1 year. I'm still sharing my screen, right?
Yeah.
This is 1 year inflation break evens, right? I mean, so, they've come a long way from where we were earlier in the year. They're basically at the levels that we saw back in September when the Fed was still looking to hike rates. This is 2-year inflation expectations or break even yields. A nice 2 basis point move today, kind of broke out to 2.5%. I didn't even look. Let's see, 5-year is a little bit less, but moved up 4 basis points, right? I mean, inflation swaps kind of got the joke, right? They moved higher. So the market is calling or is going to try to call BS on Powell's view that easing of financial conditions doesn't matter. And I think that was a risk to my view about being negative, which is why I had calls on inflation assets. And I think those are, I still feel pretty good about them.
All right. I was asked, could you expand on the thesis, at least mine, why markets can go a little lower into month end? Because as you know, I have been bullish into this kind of 53.20 area, the Qs into 472, that was established back in January. So in November, got very bullish. January doubled down, but into this gold spike, which is really my whole thesis I'm getting to. This gold spike basically said, whoa, whoa, whoa. This crash up scenario in NASDAQ, I think, is going to slow down. And now that it had slowed down into FOMC, I think this spike today is mostly the puts that are getting reversed.
Yep.
As it relates to the hedging around FOMC. VIX, of course, with expiration today, and FOMC is typically that vol crush event. We also have end of quarter. We've got a lot of options that come off the board end of quarter. I'm looking for basically this short duration spike into and through the call wall of 5,200 to get unwound probably by the end of the week, more sideways into end of month. And then I'm going to be looking for option structure to see if we've really got a robust kind of backdrop for overall market bullishness into that 53.20, 53.40 area. So I'm not turning bear. I'm not saying volatility is about ready to erupt. I'm saying this gold spike that I talked about on March 1st usually means NASDAQ is going to slow down. And it had, it really went sideways until today. So I'm very much a dollar bear, and that's why I can see equities continuing higher. But this gold strength after we've had such strong food inflation, and now industrial commodities are absolutely starting to get bid, makes me feel that today was a little instrumental in that maybe the Fed really has de-anchored inflation, right? So I haven't used those words, but I'm looking for it.
Yeah.
Jeffrey talks about it a lot. You talk about it a lot.
Yeah.
We're kind of we're around the edges here of fiscal dominance. Some say no. But I am learning more and more about it in the past year, going and reading more and more about it in the past year, going yes. So the dollar is the reason why the falling dollar and relative weakness in treasuries is just making it more intense for this equity rally, but I don't see it as sustainable. So anyway, I'm just looking for this end of month chop, and then we'll see if I can really see a robust option market for April, May and June. Otherwise, I'm not bearish yet. I'm just very cautious because it's kind of coming together a little bit faster than I expected. Let's put it that way.
Yep. No, look, I think that's that's kind of where I am as well, right? I think what I've been saying is that the Fed needs to deal with the loosening of financial conditions and the reacceleration of inflation expectations, animal spirits, and inflation. And the longer it takes for them to deal with it, the more the market is going to test and find the level that makes them uncomfortable. And so today, with gold at wherever it was, 2,100, and Bitcoin at 65,000, and S&P at 5,200, and Nvidia at 900, the Fed said, and oil at 83, whatever it is, the Fed basically said, we're not uncomfortable yet. So the next move is all those assets moving higher, probably at an increased velocity.
That's my
and then we get to a point where the Fed becomes uncomfortable. So look, this could happen over this level of uncomfortable. This could happen over a course of a week or two or three, right? It's if gold could go up 5-10% in the next several days, Bitcoin could be at 80,000. Oh, I said Bitcoin at 100,000, gold at 2,500, oil at 100, right? Like the market could move in that direction rapidly, and then the Fed is going to have a real problem. I think that's how we're going to trade over the course of the next several days. But I agree. I think it's possible equities may not deliver, or to your point, the equities that folks own may not be the beneficiary of the increased flows. And that's why I want to, that's why I'm not long equities. So I'm kind of on board with that.
But there's one last thing, and then I know the power hour is over and we've gone through the questions. Just a few weeks ago, I actually retweeted, I'm looking for it right now, but I'm not finding it. Bank of America talking about, we're getting a little worried. This is about currency debasement, right? And then yesterday, Morgan Stanley comes out and says, consider preparing for a US dollar regime shift that could crash US stock. Now, hold on, let me read the whole sentence because literally I just found it and retweeted it, by the way, if you want to check my website. It's Morningstar News, okay? A strong US dollar has been a vital, if often overlooked, source of support for US stocks since the 2008 financial crisis. But this could soon change as the greenback enters a prolonged period of weakness, according to a top Morgan Stanley strategist. Now, I've been talking about this since November, right? So it's so bullish, it's bearish. Where the dollar falls, And US Treasuries, obviously, they're just worth less than they were. But that isn't a worry for equity holders because housing stays really nicely bid, equity stays really nicely bid, speculative assets, because we have so much money sloshing about, finds a way to express itself, Bitcoin and the like. My point is, at a point, the market's going to say, hey, wait a minute, maybe this falling dollar is bearish. And that's where I today, for the first time, said, wait a minute, I think actually the market's catching on. I don't think this spike, I'm still the one who said in January, I see 53.20 and Q's at 472. But today, the whole combo deal where yields were suppressed and the dollar dumped hard and gold has been my tell since March 1st, right? That the equity rally has run too hot too soon. Too much too soon, makes me wonder if maybe the rest of the market will start to see the same thing.
I think
that's all. It's early. It's very early.
The way, and I talked about how to, the way it breaks apart is when rates volatility picks up in treasuries and folks start to think, shit, like, why do I own a 30-year bond? Right.
You're
so
right.
It's all what you're talking about. So this is
over.
This is okay. So if you believe that the U.S. government is going to continue to run 6-7%, deficits at, with basically full employment and debt to GDP over 120%. If you believe that that's going to happen into perpetuity, which seems like a reasonable suggestion because the CBO is projecting that there is no desire or appetite in Congress to raise taxes or to cut spending. So it's a fairly good assumption that that's going to continue. And you then believe that the Fed is not going to be serious about bringing inflation back down to 2%, then why would you own a long bond? And I think that reality is starting to become part of the narrative, right? That's why gold has been doing what it's been doing. That's why Bitcoin's been doing what it's been doing. That's why people want out of treasuries. They want out of this currency that is being debased by a profligate government and a central bank that is doing nothing to stop it. And like it's in the undercurrent of the narrative of markets, right? Part of what I've read about this, this idea of, financial nihilism where, folks are speculating more and are, trying to keep up with inflation. They're doing YOLO calls and meme coin, sports betting and parlays and just there is a fervor that people realize that they are getting effed by the government and that the dollar is getting debased and that inflation, and they're being gaslit by a government that's telling them inflation is returning to 2% when they're paying 15 to 20% more for every one of their insurance bills. As like it's BS, right? Larry Summers had a comment from I think it was last week or 2 weeks ago, where he said if we still calculated inflation like we did in the late 70s, and with Okun's law, that peak inflation last year, again, would have been 18% year over year. Like people, the populace, the public understands that.
Well, because we understand compounding, right? So in the real world,
so
that's not how they measure it on Wall Street. It's all rate of change.
People get that they're being gaslit. Yeah. People understand that the only way for them to keep up with this level of inflation is to speculate and to gamble, and because the only way to keep pace. And I think that's what we're doing. And as long as the Fed says that's okay, then it's going to keep going until we get to the point where it's uncomfortable. And I thought there was a very good chance that it was going to be a Fed recognition that we were it was already getting uncomfortable. I even thought that the dot plot suggested that they were a bit uncomfortable. And then Powell came in and said that he's not uncomfortable really at all. So hence, wouldn't surprise me if when gold makes a new high the next few days, blasts through 2,200, and Bitcoin makes a new high and blasts through 75,000, and oil makes a recent high and goes to 90. That I think that reality will start to come into the narrative that the Fed has made a mistake, and at that point, then maybe we'll be back to the same song and dance again. When are they going to raise? But again, it's about the data. The Fed needs to see it in the data, and for some reason they think the data doesn't reflect it, and they haven't been hit over the head by the data frying pan. I think largely because oil hasn't broken out yet. And maybe it is political. Maybe it can never break out. Maybe there is, enough of a backroom deal between the U.S. and Saudi and whatever to keep it. I don't know. We're getting highly conspiratorial, but it is election year, so it's fair to think some of that's the case. But my sense is oil is going to go here.
Okay, so let's talk about lastly, macro event risks coming up, so we can kind of wind down. Since we have FOMC out of the way, we do have quarter end, and we do have a few events before the early May meeting. What are they, and what are you looking out for, especially auctions, which, as you say, have been weak sauce?
Yeah. So I'm just looking right now at Fed speak. And so weird. Like, actually, Powell is giving some opening comments at a Fed Listens event on Friday. So I don't anticipate that he's going to say anything different, but he's speaking at an event with Jefferson and Bowman on Friday with community leaders. But I don't think that's going to be much. But then you have, Barr speaking, Bostic speaks on Friday and again next week, and then Mester speaks on the second, and all these guys are going to speak, right? So you're going to get an update on how each of these Fed members kind of views the world. Do they agree with Powell's assessment or not? As far as macro data next week is concerned, look, there's not, we'll get a flash PMI tomorrow, which I don't really think is much. And then next Friday, which is Good Friday, the market is closed. We get core PCE, futures will be opened, market's closed, kind of a bizarre situation.
We just got the data today.
But it's not, the only risk there is that we will get a super core reading on core PCE, which was hot in the data last month. So again, this is the core services ex housing component that is remains very sticky. So look, there is risk to that number. And then we have quarter end, and we mentioned earlier that there is pension rebalance at quarter end. That's equities for sale. The buyback window for share buybacks will go into blackout fully by the end of by the middle of next week, and certainly into the end of next week. And so, and typically the RRP builds the last week of the quarter for window dressing. So, and then next week we have
QRA at the very tail.
The next week we have 2s, 5s, and 7-year auctions next week. So there is a little bit of macro going on next week. And if my view is that yields are moving higher because of a Fed that is embracing higher inflation, well, then I don't know how well the demand for 2s and 5s and 7s are going to be, but we'll see. We'll find out. So there is some of that. There is some of that risk next week. And then first week of April is, traditional labor data and PMIs. Japan is kind of out of the way. ECB is kind of out of the way for now. China is kind of out of the way. We'll get some of the China data, but no real big expectations, for China to just kind of continue doing what it's doing. So look, again, I think the thing I'd be looking for is if and when does rates volatility start to bottom and move higher? When does term premium rise? When does rates volatility pick up? How do people think about the back end in light of the increase in supply that's coming and a Fed that is, maybe not serious about getting inflation to 2%. I think that is the pathway. And I wrote that piece a few weeks ago about how does the bubble pop. That was the crux of it. So I'm still looking for that. I thought there would be a good chance that we would address some of that today. And we didn't. So now we have to find the level of uncomfortability.
Yep,
I don't know what the word is. What's that? And I think we will. I think we'll get there. I don't think we're going to get there in a day, right? I think we'll get there over the course of the next couple of weeks. It's very possible, we'll see material, rises in gold and Bitcoin and oil and inflation expectations and the like. So I think I would trade in that direction now. I think you should own inflation assets. I think you should be short bonds. And I think you should be kind of looking to, rates volatility picking up as a flag, as a signpost to start, cycling into a larger short position in equities. Because equities and duration assets will sell off as term premiums rise and as yields move higher.
And I would not sell precious metals. I would hold on to them.
I agree. I've been long gold for a while, and
you have.
And I'm still in Bitcoin. I'll use my indicators, right? We'll keep looking to see how overbought or oversold they get. But
Europe.
the last thing I would say is maybe this is ultimately how it had to happen, right? Maybe we needed to get to a point where the market tested the Fed and the Fed said, we don't care. And then now the market will really And so, you know what I mean? Like maybe even though I would have thought that gold at 2,100 and Bitcoin doing it, maybe I thought that it was enough. Maybe we actually needed to test the Fed that one time, and they said, nope, not a problem. And now we really go and test them. And maybe it was wishful thinking for me to think that the Fed was going to believe that loosening of financial conditions were going to matter, even though several of them have been talking about it. But I don't view it as. I think it was a properly calculated risk bet to take, and now I think it could get very interesting very quickly here. And so,
but we're still squiggling about for the next, quarter probably. Just real quick, inflation running hotter, dollar weaker, international emerging markets get better bids or flows. I think we've already seen that, especially in Japan. They're liking this, higher inflation, and China bottoming. They actually had a, CPI that was 0.7, which beats all the deflation numbers that have been coming out of there. Right now, it's definitely euro over yen, but not to answer or not to avoid Thomas's question. He's like, I get the fiat weakness, but what says U.S. dollar will be hit harder than the euro? So wouldn't Europe be in kind of a worse situation? I don't know. I tracked the German exports. They were extremely strong, and they're
Europe is bottoming also, right? Europe suffered a growth slowdown last year that was way worse than certainly what we got in the U.S. And seems like
their energy crisis was worse. It was as bad as World War II. So that's comparable.
And it seems like the data is bottoming there. But if the energy price inflation that I expect comes, it's a bigger problem for Europe again. So I think dollar euro is just kind of like not that interesting. So
even the British pound, the sterling dollar has not been doing anything either.
Yeah,
but euro over yen, the euro JPY has been
it's been breaking out. I mean,
very
it certainly
strong.
is breaking out. So
and dollar yen, everything to me hinges on 152. So above that,
I think we're gonna. I think we're gonna break it. I think we're gonna go higher.
But when? It's all about the timing of when. Right now.
I mean, I think we are. Look, I mean, I don't think that. I think they're going to keep trying to test. Look, I mean, an Nikkei article about raising rates in July is different than speculation that the MOF is intervening, and so
100%.
I think.
Yeah,
and I think that once we look at it, it wasn't a surprise that we tested the highs in dollar yen today and we failed. And so we get a little retrace, but I think 150 dollar yen gets bought and they try to run through 152. And if we go to 155. And I think that would be
165.
We got to get to 155 before 165.
Once we get and stay above 152. I see 165 in time.
That makes sense. And I think that would come as oil prices are rising, right? Because Japan is the biggest, not that it's the biggest, but as a percentage of GDP, it's a significant energy importer. So as energy prices continue to fail.
I don't even need oil for this scenario.
I mean, I think if we get oil going, it's going to get you'll get there faster. I guess
it will get there faster, but I don't even need it. It could stay where it is. The weakness in bonds will help that trade. But first, we got to get there and stay above, and that's not today. All right, I'm gonna say thank you so much for joining us. This has been Macro to Micro Power Hour. LaDucTrading.com. You know where to find us on Twitter. Hopefully, both Craig and myself. And LaDucTrading.com for our Club and Edge services, where you get this every day from us, not necessarily together debating, but definitely full-time engagement. We do a lot of it for clients. So I'm going to wish you all a great rest of the trading week, and we'll pick this up in another month or so for the public. We do this all the time for clients. All right, cheers. Thank you, Craig, so much for your interpretation, and wish you a great rest of the week.
Take care.
Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.